Welcome to my channel. I'm Scott, and in this video we're going to talk about derivatives. The first slide is high-level information on the topic, and then the next slides are terms you should know. So a derivative is a security whose value is determined by an underlying asset, such as a stock, like Apple stock, the price of a commodity like oil, or maybe something like a mortgage bond. People use derivatives for hedging. They also use it to increase leverage or to speculate on an asset. Most options are bought or sold on the open market, so you can buy them through your broker, but certain options like warrants are sold by the company. For example, Tesla may sell warrants. This gives you the option to buy Tesla stock at a predetermined price, but the warrant doesn't trade in the open market. There are many types of derivative contracts: options, swaps, futures, forwards, and the list goes on and on. And there is a lot of risk with options, as market risk, volatility risk, and leverage risk. So let's go through lots of terms you should know. So what is a counterparty? That's the person or entity that's on the other side of the trade. So if you buy a call option, the person selling that option is a counterparty. And if you sell a put option, the person buying the put is the counterparty. So you might hear a strike or exercise price. This is the price the option can be executed at. When you hear the term long, that means you take a bullish position. You hope the asset goes up. When you short a position, that's bearish. You hope something goes down. You could also take advantage of neutral positions. This is when you make money when the underlying asset is flat. Another example of a neutral position is when you long and short something. Arbitrage is taking advantage of different prices of the same security. So maybe the stock price for a company is trading at different prices in New York and London. So you could buy it in New York and sell it in London, or vice versa. When you hear an at-the-market trade, this is when you buy or sell something at the current market prices. So it's like a market order. The Black-Scholes pricing model is an equation for valuing plain vanilla options. It was developed by Fisher Black and Myron Scholes almost 50 years ago. A collar is when the holder of the contract has bought out-of-the-money calls or puts and sold out-of-the-money calls or puts. Contango is usually used in commodities or future markets. This refers to markets where shorter dated contracts trade at a lower price than longer dated contracts, which is usually not the case. Convexity is if the financial instrument's price increases faster than the corresponding changes in the underlying asset. We're going to talk about a lot of Greeks later, but some uncommon Greeks are lambda, epsilon, vama, vera, and sama. These are the second or third derivatives of the pricing model. When you hear covered call options, this is when you sell a call on a security you already own. Naked calls is when you sell a call on a security you do not own. And that's the riskiest investment, because theoretically the price of the underlying security could go to infinity. And if you don't own it, you have to buy it in the open market to close out your option contract. Currency swaps and interest rate swaps are really popular. This is when you pay to receive a guaranteed rate. Say I do a lot of business in London, so I have to buy a lot of products, but I have to pay in pounds, even though I'm in the US and all my sales are in US dollars. So the price of the pound can really affect my margins. Say I make a deal with my bank, and they allow me to buy 1 million pounds for 1.15 million US dollars for the next 2 months. And currently a pound is trading at $1.18. I would need to pay a fee to my bank, so they allow me to do this. So this limits my exchange rate risk, because say in 2 weeks 1 pound costs 1.30 US dollars. Then I save a lot of money because I have this contract with my bank where I could pay $1.15. But what if it goes down? It costs $1.10 in 2 weeks for 1 British pound. Then I lose out because I have to buy 1 million pounds for 1.15 million US dollars. Really, the purpose of currency swaps and interest rate swaps are to know how much money you're spending. You're not looking to play the market, you're just looking to get a fixed payment so you know how much things are going to cost. Delta is the fourth letter in the Greek alphabet. It's a sensitivity of the change in a financial instrument's price to changes in the underlying asset. When you hear duration, think of time. This is the weighted average of cash flows expressed in time. So if a certain time frame has a higher cash flow, things will be weighted more towards that time frame. So if there's a large cash outflow, say in 2025, then things will be weighted more towards 2025 than say in 2028 where there's a small cash outflow. When you hear European style options, it's an option that can be exercised only at expiration. American style options can be exercised anytime at or before expiration. Exotic derivatives are not plain vanilla options. Examples are barrier options, average rate or average strike options, look back options, and chooser. When you hear a forward contract, that's when you could buy, sell, or make payments at some time in the future. Gamma is a third letter in the Greek language. That's the degree of curvature in a financial contract's price curve with respect to its underlying price. So it's a rate of change of delta with respect to changes in an underlying asset. So positive gamma is favorable while negative gamma is bad. So the price of positive gamma or owning gamma is time decay. Only investments with time value have positive gamma. Because if there's no time left to execute your option, there's no gamma, there's no value. A hedge is a transaction that offsets the exposure in other investments. So maybe you can say buying a Tesla is a hedge against oil. Because if oil prices shoot way up, your hedge is owning a Tesla. You don't have to spend money in oil. At least for the car, you have to spend it in other things, of course. When you hear in the money, that's an option with positive value. If the option were to mature immediately, the holder would exercise it and capture its value. So for a call option to have intrinsic value, the strike must be less than a spot price. For a put, the strike must be greater than a spot. Intrinsic value is really what the option is worth. Knock-in options is an option which is conditional upon a preset trigger, maybe if oil hits a certain price. If the trigger does not occur before maturity, the option expires worthless. Look-back options give the owner the right to buy at the lowest price the security has ever traded at. Margin is posting cash or stock or really any asset with the entity that's selling you the financial instrument. So that means if you don't come up with your money, then they could take your margin. Mark-to-market accounting, this is when something is revalued at regular intervals using current market prices. It's like taking a snapshot of the market. So say you wanted to get a business loan and you pay $300,000 of cash for your home, but you paid 2 years ago for your home. You can't list $300,000 as an asset for your home. You have to see what your house can sell at in the open market. Say your house can sell at $400,000 in the open market, which is great. That's like marking your home up. But currently, if your house could only sell for $250,000, you have to mark it down. A market maker is someone who guarantees to make a bid and ask on the same financial contract. They earn money between the spread of the bid and ask. It's like the vig a bookie receives on a sports bet. It doesn't matter if the team wins or loses, they still make money. Buying a call option gives you the right, but not obligation, to buy a security at a predetermined price at or before the expiration date. When you buy a put option, this gives you the right to sell something at a predetermined price before the expiration date. And when you sell a call or put, then you're selling someone this right, and you receive a premium for the risk you're taking. When you hear over the counter, that's any transaction that takes place between two people that does not involve an exchange, like the NASDAQ. It's less regulated than under the counter. I don't know if that's a term, under the counter. I just wrote that, but I think you understand what I mean. Premium is the cost of a derivative contract. The buyer pays the seller a premium. You could think of it as a fee, because you don't get your premium back. Say you buy call options and you end up making $12,000 on that trade, but you have to look at your premium. What if your premium was $15,000? You lost $3,000, and a premium could be really, really high, because if you buy in the money options, it's going to be really high, the premium. If you buy way out of the money options, it'll be a really low premium. And if you buy long dated options, the premium will be higher than short dated options. Rho is a 17th letter in the Greek alphabet. It's a change between an option's value and a 1% change in interest rates. The spot is the current market price. An asset, that could be a stock, a commodity, a currency, can be bought or sold for immediate delivery. So the oil spot price is what oil is trading at today. Spread is the difference in price or yield between two assets. So when you see the bid-ask spread on a stock, the bid is how much someone is willing to pay for a stock, and the ask is how much someone is willing to sell a stock. It's usually pretty close for a regular stock. but the bid-ask spread for a small business can be really wide. The seller may want $1 million for the business, but the highest anybody's willing to pay is $200,000. It's a pretty big spread. The more liquid an asset is, the tighter the spread. So a stock is a very liquid asset. It gets traded a lot. A house is not as liquid as a stock, and most small businesses are not as liquid as a house. The credit spread is the difference in yield between a corporate bond and a similar government bond. When I say similar, I mean similar characteristics, like a similar maturity date. Yield curve spread is a spread between two government bonds of differing maturity. Standard deviation is a statistical measure of dispersion around the mean. Something with a low standard deviation is when the data is clustered around the mean. A high standard deviation is when data is more spread out. Theta is the 8th letter in the Greek alphabet. This is a sensitivity of a derivative value to changes in the date, assuming other factors stay the same. Value at risk is a maximum expected loss for a given portfolio, and the yield curve is the yield plotted by maturity for a series of fixed income investments like government bonds. So I know the topic was derivatives, and I really focus on definitions, but I think if you understand these definitions well, then when you trade options, a lot of things start to make sense. So hope you learned something new. Please subscribe, comment, leave a like. Thanks for watching.